So the world's financial markets are in turmoil. Stock markets are way down from their peak. Interest rates are rising. We have inflation and we have fears of future inflation. The crypto markets are in a total bloodbath. So the big question is there any way that real estate avoids all this chaos? And how do we communicate with buyers and sellers right now? They know these conditions, but frankly, we still have bidding wars on many homes in many parts of the country right now. My brother this week lost to a higher bidder on a home in Pennsylvania, just Sunday. So how do we reconcile both of these conditions? What questions can you be asking your clients about their expectations and their needs to help set their frame for whether it's a good time to make a confident decision buying or selling their home? I'm Mike Simonsen. I'm the CEO of Altos Research. And every week, Altos Research tracks every home for sale in the country. We do the analytics on all the pricing and all the supply and demand. We do the changes in that data, and then we make it available to you before you see it in the traditional channels. And for the realtors and the professionals on this call today, this is how you can be helping your clients through the fears that they have right now. So much uncertainty in this market, so much fear is happening. And the data is really how we get people past the fears. So before we dive in today, a little housekeeping. We have a lot of people, 1,300 people registered for the webinar today, all over the country. We have as we go along, I have a lot of data to share, and as we go along, please use the chat box for asking questions, and also to look for links. Sometimes I'll mention links of places you can click and resources you can go get. Both Lael and Jeff from the Altos team are in the chat, and they will be sharing links and helping to answer questions along the way. And then as we wrap up, I will we'll stick around and we'll try to answer any last questions at the end of the session. So let's look at the agenda for today. You know, the title of the webinar is, what do we really look for? What stats can we watch in a shifting housing market? Well, inventory numbers and price reduction numbers have been really leading our headlines the last few weeks. And so we'll spend some time with both inventory and price reductions, what it means. We're going to look locally at these as well and see some of the markets that are changing most quickly and the ones that are a little more resilient at the moment. What else we can look for this shift and how to talk about it with our clients. You know, a big question is, will home prices fall? What do we know about that right now? What does the data show us right now about the future of home prices and the future of inventory levels? So those are the ideas we're going to get to. We will finish up the session with local market data as we normally do. We can't get to all local markets, of course. So you can always book time with our team, free consultation for a free local market review. You can review with our team how to use the market data, how to talk about the market data, the questions to ask with your clients right now. So keep a lookout for that as we go on. Let's start today with the big headline. Interest rates, mortgage rates on the 30-year mortgage have spiked up to over 6% this week. The Fed is raising its borrowing rates, and while mortgage rates aren't directly correlated to what the Fed does, they're more correlated to the expectations of what the Fed will need to do. And what happened last Friday was we had inflation numbers that were higher than expected, and all of a sudden the people like the mortgage buyers recognize that in the future the Fed is probably going to have to raise interest rates even more to control inflation, and therefore mortgage rates spiked before the Fed did anything, really on the expectations. And you know, we show this 10 years of chart here. Each color is a year, you can see, and we've been around 4% for a decade. The last couple of years, we've been under 4, under 3%. And everybody knows that cheap money has provided a really good incentive to buy homes. So as rates are now over 6, that has to have an impact on demand. And really, I actually have a question. I have a little poll today. I'm curious of our crew here, of our audience. I'm interested in your take. So I'm going to launch a little poll. You can vote on this poll. It's a multiple choice. And I'm just curious to see, how have rising mortgage rates impacted your business? Are your buyers still going full strength? Are people telling you that they can't afford to buy and they're backing off? Are rising rates incentivizing new sellers? So some people are trying to get out quickly. Or are some sellers scared, and are they holding off? And we've got a lot of people on. I'm going to let people vote, and we're going to see how that comes out. And then I will share the results in just a minute. So really, it's like we know that these rates are there. And the question is, how are people seeing it? Like I mentioned at the start, my brother just made an offer on a house in Pennsylvania. He has a life event change. It's time they are moving closer to his wife's parents, the in-laws, to take care of them as they age. So it's time for them to move. They need to buy a house, and they're buying a house. So they're making an offer. And what was interesting is that they lost on somebody overbid them, and they lost on a competitive offer this weekend. So I'm going to share our results of our poll real quick. And so, the biggest trend here, many of my buyers now can't afford to buy. And so that is the quote demand destruction that rising rates has on the market. Many of our buyers are still buying. This is like my brother. And so while we have a lot of activity still happening, we can definitely see many of the buyers now can't afford. And so that's slowing us down. And we can see it in the data all over the place. This is the shift. We have definitely shifted from the hot frenzy market to a much more normal market. And then here on the supply side, I now have sellers eager to get out before the market gets even worse, right? So that is, so we can see the demand decreasing and supply increasing as a result of rising rates. Like, it's a fascinating time for us. That dynamic is kicking in strong. All right, thank you for that. So we're in this case, we have rising rates. As I say, I don't have any ability to predict where rates will go. Rates stayed lower way longer than I expected them to. And they then, when they started rising, they jumped way faster, way higher than I expected to. If you listen to our Altos podcast, the Top of Mind podcast, I had some folks on earlier in this year, like in January, who were expecting 4.5% very quickly. Let me see if I can share there. How about there? Am I sharing the poll results now? All right, here's our results. This is where I was saying we have buyers still buying, but you can see the demand destruction. Many of our buyers now can't afford to buy. That's the biggest one here. And here is our supply coming on. New sellers eager to get out. So we have demand weakening and supply increasing. And lower numbers are people waiting to sell because they're worried, or people still buying, although there are a lot of people still buying. So there's our results of the poll. Sorry about that. Okay. So let's move on. So we know that rates are up. I don't have any ability to predict where rates will go. Is this a temporary spike? Do they go higher from here? We don't know. If I knew, I'd be trading interest rates, not doing real estate market data. But as of right now, we know this is having a really dramatic impact. So where do we see the impact? The first place we can see is in inventory numbers. So this is the total inventory of active homes for sale, unsold, on the market, single family homes across the US. Uh, there are 396,000 as of last Friday. That's up 5.5% from the week before, climbing very steeply, but still very far below where normal is. Normally, even in say 2019, this time of year, we'd have just under 1 million homes on the market, single family homes on the market. And we only have 400,000 right now. So this is why while we see the market slowing and we have buyers who can't buy, we still have bidding wars because there are too few homes on the market, way fewer than normal. So that, we're going 90 miles an hour and we took our foot off the gas. We're still going very fast. We're slowing now. A couple other things to note about the inventory. Over the last decade, each year we tend to have fewer and fewer homes available on the active market. Fewer homes are for sale. That's for a couple of reasons. One is that we have, as Americans, have turned homes from resale into investment rental properties. Sometimes we do that because when we move to the next home, we keep the first one for a rental unit. And now we have just one rental unit. Sometimes it's small investors buying 1 to 4 units as rental units. And some of it is big institutional money buying a lot of homes. About 90% of the homes, the rental units are owned by individuals, and less than 10% are owned by big corporations or the big hedge funds. But it's all Americans, and we've been doing it every year. As mortgage rates have been really low, it's been a really good time to have a cheaply financed, nice cash flowing investment unit. And so you can see the peak, the summer peak, each of these years keeps falling. The only time inventory rose year over year was here in 2019 from 2018. And 2018, we had rising rates. So rates rose from 3.9 to 4.9% during 2018. And as a result, we started 2019 with more inventory than the year before. And what we have right now is year over year inventory gains again. So rates rose, we have year over year inventory gains. And so we're at 396,000 versus 342 last year. And so those inventory gains are now that's an unusual condition for us in the country. We're still low, but they're gaining, and they're going to continue to gain likely through September before we start seeing the seasonal drop off in inventory for the end of the year. We're going to end the year with more inventory than we ended 2021. And one of the implications of that is year over year inventory gains are correlated with flat pricing a year further out in the future. So year over year, when inventory falls, that's correlated with pricing increasing the following year. When inventory gains, that's correlated with inventory flat or falling in the following year. So what this implies is that we can see for 2023 likely no home price appreciation across the country in 2023. That's roughly. We don't see any conditions in the data for massive home price declines or notable home price crash. There's no crash signals in the data. The only places that you might see crash signals are in all the other financial markets. That's something to keep in mind, but there's no place in the housing data yet where you see anything that is crash. For example, we'd have to have inventory climb way back up here to 1 million homes to even be normal. So there's a long way from anything that's super crashy. But you can see that we had these big home price gains because we had these big year over year inventory declines, a lot fewer supply, a lot more demand. That led to the price increase. So that's one thing to keep in mind. What the current inventory situation tells us about price appreciation for 2023. This is here's how we can look at inventory in a forecast. So how does the year look? Each line on this chart is a year. And you can see the dark red line is this year, and the dots are the forecast for the rest of the year. We can see the light red line is last year. So we now have inventory gains. In general, each year we have fewer and fewer. The line is lower and lower on this chart each year. The dark blue line up here in 2018, rates were rising, and we finished the year with higher inventory. You can see it starts the year lower than most of those, than all the other previous years, and it ends the year a little bit higher. That was the impact of going from 3.9 to 4.9%. We're going now from 3 to 6.5. And so a much bigger inventory gain for the year. You can see how the forecast ends. So we're ending the year 470,000 or so is the current forecast. The inventory gains weekly have been very steep, and so climbing, and so probably end with the highest inventory of anywhere in the last 2 years. So that's what the forecast looks like. I have up for you on the Altos Advanced Analytics System. I'm going to look here at the states. I have all 50 states ranked, and with a spark line. This spark line shows us this is the trend of inventory of the last year. It's ranked by the most inventory. We have Texas is the most. California is next. Even though California is a lot more people, Texas has more homes for sale, which is why Texas is more affordable. You can see that with using the spark line is really cool, because you can see that California started climbing inventory on January 1st, where Texas didn't start climbing until March. You can see, here's another thing you can see. Look at the steepness of the climb in Florida, for example. And so that's really April before it started turning the corner. Florida now has its highest inventory anywhere in the last 2 years, as does California, last year, as does California. Texas still has a little bit to go before. So that's showing is that Florida hitting the brakes faster than some of the other states. If we look through these really quickly, you can see places like the Northeast, Pennsylvania, New Jersey, inventory is climbing, but more slowly. Look at Arizona. So Arizona is what had really low inventory and is now climbing very quickly. And you can see that in the spark line. South Carolina climbing very quickly. If we keep scrolling down, here's Colorado. So all of the hot markets that we've seen, we can see them adjusting. Idaho is the one that I'm keeping my eye on most closely, and we'll look at Boise when we look at the local markets in a little bit. So you can use the spark lines for that. It's really a fascinating time to see which of the markets are adjusting more rapidly. You know, in New York, for example, New York's a big state. There's a lot of homes for sale, but hasn't really turned that corner the way Florida has. You can see the steepness, the comparison there. So that's looking at the state level inventory. And like I said, we'll look at a little bit more of the local level trends. We'll look at some metro level trends as we get further down. Prices, home prices. So as I was mentioning, while we have inventory climbing, and we do have, we'll talk about price reductions in a minute. We are at record home prices across the country. The median price of single family homes in the US is $450,000. Now it's June. It's always the peak of the year. And you can see each year here has a peak, a summer peak, and a little plateau before prices, they recede a little bit in the fall and for the holidays. So, you know, if you need to sell your house in November, you price it at a little discount to make sure that it moves. And so prices recede a little bit each year. You have that annual cycle. And we're at the peak. Prices tend to cluster around the big round numbers. So 450,000 is exactly where we're clustered right now. Last summer, it was 400. And so what this shows us is lots of equity gains. Sellers anybody who bought anywhere except maybe in somewhere here, if somebody has to sell really quickly or in a few local markets, has lots of equity gains. So even if you are selling your home right now and the market's slower than you were expecting, you still have a lot of equity and still have a lot of leeway to price the property properly so that it can sell. So we expect this to be along this summer plateau for a while this summer, and then start receding. what I would expect is that we're going to end the year higher than the previous year. And then next spring, because we've had the year-over-year inventory gains I mentioned, next spring isn't going to be nearly this steep. And so we're gonna end, and we're gonna be roughly around the same peak next summer. So I'm expecting zero, essentially no home price appreciation for the year 2023, based on what we can see in inventory right now. The new listings price, that's the light colored line here. This is these are the cohort of homes that are on the market that this week, the new ones that get listed each week. And you can see that the price of new listings peaks and plateaus each year before the full market, and it peaks lower because you have a little turnover at the lower end of the market, faster turnover at the lower end of the market. And so what it's showing us is that this remained very strong until April. We're at our plateau, and for a 425 there. Home prices, the new listings prices haven't started ticking down yet, ticking down like extraordinarily fast, for example. There's no signal in the new listings prices that, for example, bidding wars are gone, and therefore we got to cut our new listings prices. What we're doing is the price cuts are the ones that are most overpriced. And so people are still buying the ones that are properly priced. And you can really see it here in this price of new listings. If demand were really dropping, then we'll start to see this light colored line start to fall faster and steeper. And you know, depending on what happens with the economy and mortgage rates, we could still see that later this year. As of right now, there's nothing in the data that shows a deeper crash. But the other really big headline right now, and it's a really important topic to be discussing with your sellers, is the percentage of homes on the market with price reductions. The dark red line here is this year's curve. And you can see that price reductions are climbing more rapidly than they have anytime since we've been tracking it. They are 25.5% of homes on the market right now have had price reductions. You can see in March, it turned the corner, and we said, you know, that's when rates started climbing. That's when like the market changes really started happening. And so what this is a function of is normally times about a third of the homes that get listed take a price cut. Normally, sometimes that's intentional, sometimes it's accidental, sometimes it's a crazy seller that wants to waste your time as a listing agent. But whatever the reason, about a third normally take a price cut. When the market is hot, fewer homes take a cut. You know, I overprice my home and I get my offers, surprise, so I don't have to take a price cut. And we're shifting from this ultra fast market where we had hyper competitive, nobody had to do a price cut, to now, if you're overpriced, you're going to sit and you're going to cut your price. And what we can see here is 2020 is this tan line here. And, you know, we rolled into the pandemic and we started buying everything in sight. And so no price reductions had to happen. Then last year, the market accelerated into that frenzy. We had fewer price reductions all the way into May. And then you have your normal season started to kick in. As the price reductions were climbing last July, we were, if you remember these webinars, if you were on these webinars, we were talking about how it feels like we're getting closer to normal, like things are starting to normalize a little bit. And they did, but by the end of last year, they kind of accelerated again, and we started this year in this real steep frenzy. So what we can see now is a trajectory of the price reductions is that we're going to get over 30% probably in July, and then maybe 35%. We get up in this range, and I'll show you in a minute some of the local markets where we do price reductions. We're talking about price reductions. We can see the ones that are needing to reduce more quickly. They were more frothy, and the buyers have backed off. This dark blue line you can see is 20 2018, mortgage rates were rising. And by the late summer of 2018, if you were selling your home, you listed your home in August or September, you might have been surprised at how slow it felt. It started to slow way down from a much faster market earlier in the year. And it was still kind of in the normal range. And so that's what sellers are going to feel this fall. This summer, they're going to feel like, wow, it slowed way down, even though we're back into normal range. That's still going to feel really slow. If we watch price reductions climb here in, say, September over 37% up to closer to 40%, that's going to be a real bearish signal for home prices, that transactions that happen in 2023. My guess is that we're going to get it's going to climb up here to one of these highest levels, and then we'll get our seasonal curve. It'll climb back down, come back down, and we'll start to have a normal seasonal curve. We'll get back into the normal level of price reductions. I think we're going to go above these though, and it's going to feel really slow. So sellers right now, you want to price the home properly right now, because you want it to move as quick as you can now, so that it doesn't linger around into August or September when it's going to feel even worse. That's what the data is showing us in that on price reductions. On the demand side, we've been tracking the immediate sales, and the immediate sales have really been the defining characteristic of the pandemic boom of the last 2 years. These are homes that get listed and they take offers and go into contract within hours or just a couple of days. And what we see here is that we still have immediate sales happening. So across the country, we still have buyers buy it. We have my brother who got outbid with multiple offers on a place in Pennsylvania just Sunday. So the light red portion of the line, those are the immediate sales of the new listings that went into contract immediately. We had 86,000 or 87,000 that were new listed that stayed on the market, that didn't go in immediately. And that is the highest level we've seen since last year. And so we have supply. We can see the supply coming to market. Some of them are still going very quickly, and that's going to shrink. But in fact, the new list, the immediate sales has held up faster than I expected it to. I expected that to slow much more quickly. But frankly, I think this is evidence of a lot of pent-up demand. Buyers who've been needing to buy for the last couple of years and have been maybe getting bought out, and now they finally get their opportunities to get their homes they want to move into. As a percentage, this is the same data, but the percentage of the market. So we have currently 23% of the new listings going into contract immediately. And you can see earlier in the year, it's like 33%. And that's been falling very steadily, each week since April. Even as the market, these are the high transaction times. We have more homes for sale, and fewer of them are selling quickly. So we're going to see this guy drop as a percentage. And I don't know how low it goes. It go down to 10%. There's always some immediate sales, in the market. Usually it's probably 5 to 10%. And we're going to see where that goes before it starts to turn around again for the fall and summer. Right now, like I said, it's falling. It's notably falling. Fewer each week. Fewer homes are going into contract immediately. Fewer bidding wars. And so your sellers should know that. Your buyers actually should know that too. But still actually a fair number of those. We can look at pendings data. So one of the things that's happened during the last 2-year boom, inventory fell so far that we actually have more homes in contract than those that are active on the market. And the dark red lines here are those pending contract, and the light red line are the active inventory. And you can see where that changed last year. The active inventory kept falling. Right now, active inventory is climbing faster than the pendings. And so a normal market would have more on the market than in pending contract. So we're going to watch this shrink over time, this difference shrink over time. And we're going to see them, we're going to see it kick in there. On the rental side, so if we're in an inflationary environment, there's some fears of recession coming. And what happens if recession comes? Does that force people to sell their homes if they lose their jobs? Or if they have renters who can no longer afford to pay rent? And if that happens, we will start seeing the rent numbers decrease. So the dark red line here is the rent for single family homes. And it's at its peak. It's at its peak nationally. They've been climbing very dramatically, 10%, 12% from last year. You can see that increase from 1900 to 2250. And so we will start to see that adjust if there are people who start losing their jobs. Right now, we have employment is very strong, unemployment is very low, and therefore rents are still increasing. And therefore, investors who own homes with their cheap rates that are locked in have good revenue. So one of the reasons to be sort of bullish for housing in the next year is that rents are good, costs are low, and fixed. So that means that investors don't have a real incentive to unload their properties unless we see, for example, rents tank, and that'll be a signal for more investment properties coming to market, and adding to our available supply. Let's look at price increases. So the stat with price increases is these are the homes on the market that we've seen earlier on the market recently at a lower price. Typically, these are investor activities. These are flips. There may be some marketing things where we take it off the market and put it at a higher price point. But in general, what this shows us is when we're in a bullish market, a real strong market, you see the price increases peak. We have these two big peaks in the last 2 years as investors came into the pandemic and they were able to do flips. It turned very abruptly in the first quarter of this year. We now have 3.1% of the homes on the market with price increases. That's the fewest since the early pandemic. And then normally we'd have 2 to 4% of the market. We can see we're going to get back into that space. And the question is, does it fall below 2%? And that'd be a bearish signal. Like if we can see that investors and flippers they're not getting the homes they want, they can't put it on at a higher price. That's going to be a bearish signal for future transactions right now. So this is where we can see we were going 90 miles an hour and we took our foot off the gas. This is one of the places we can see it very clearly. Price increases. Here's another signal to watch as a leading indicator for the future. This is the percent of homes that are relisted. So they were on the market, they were pulled, maybe they went into contract, the contract fell through, and now they're getting relisted. This is, you can see some yearly jumps. What happens is in January, stuff gets pulled over the holidays and relisted in January. So you see an annual spike each January. This year, there wasn't a big January spike because things just went really quickly. The fewest, so that there's a low over the holidays and a high in January when the properties get relisted again. So normally we're in this 1 to 1.5% range. And right now we're kind of easing above 1.5%. 1.5% of the homes that are getting relisted. My expectation is that as buyer demand weakens, as credit availability or ability to actually close that loan at a price you can afford, as that weakens, you'll have homes that go into contract that come back out, and we're going to see relists climbing. That's also a bearish signal for future transaction prices. That means I tried to buy this house, I no longer can afford it with my mortgage payment. I gotta back out. The house gets relisted. The house is going to have to come back down at a lower price because the people who are trying to buy it can't afford it. So that's something that we're going to watch very closely. It's starting to ease up above this 1.5% range, currently 1.6%. And we're going to watch that climb, I think, this year. So that'll be, how high does that get? That could be a bearish indicator for future. June is peak market time in terms of speed, time on market. So we're still at, and this is days on market, we're still at our peak market time, just 21 days median across the country right now. We can see where it's starting to change though, and I'll show you that in a couple of minutes. My expectations probably next week it'll be a little higher. It starts ratcheting up this fall. We're at the low point. July usually is higher anyway, so the second half of the summer time on market starts to climb and then resets for January with the fresh new inventory. So we're still though, and this is what a lot of people feel, right? People feel that you can see things are moving quickly on the whole. And there are just some properties, some price points that are starting to take a little bit longer. And so we'll take a look at that. In each of the Altos reports, and we're going to switch over to the reports in just a minute, we break every zip code in the country, every county, city, down into 4 price range segments. The high end of the market may be behaving very differently from the low end of the market. And this is nationally. The high end of the market is about $1.2 million. The low end is under 200,000. And you can see on the right-hand side that the days on market where the demand is. If you remember last month, this chart from last month is we had the middle, the top, the second row there, the $575,000 row, that was still 14 days. And the high end and the low end starting to take slower. But the place where people are buying right at around 500,000, that was still the fastest. So that has notched slower now this week. And it's going to then by probably next week, we'll see we're at probably, closer to 4 weeks days on market. 28 days. So we can also do things like, what are you getting for your money in this price range? What does it mean? I use the quartiles, the 4 price range segments for answering the question, like, do I have a lot of competition in my price range? And we can see how many are there, what kind of properties they are. You can see in this case, the low end, the under $200,000 ones, these are 66-year-old homes. The high-end ones are generally newer. You can see they're slightly bigger. They're bigger lots. That's across the whole country. And every local market has a market segment view that, especially now when you need to set those listing price expectations, this is where we want to show, like, in your price range, this is what we can see happening to, for example, days on market. This is where we have the most competition in the market. So use your reports that way. By the way, we have at Altos, if you don't already have the Altos ebook, How to Use Market Data to Build Your Real Estate Business, it's a free ebook. You can go click through to the Altos site. There's a link here. It's also in the chat. This is where you get scripts, how to talk about the data. This is how to talk about days on market. This is how you use, for example, the market segment. So I'm talking about them in this video, but you can also use the ebook to get those scripts and understand how to communicate best to your clients right now. Let's do one more set of stats, and then we're going to switch over to local data. The Market Action Index. The Market Action Index is Altos's proprietary statistic measuring. It's a tool to answer at a glance, how's the market? It's supply versus demand, and it works like a speedometer. When that thing is higher, that means supply is tighter and demand is high. As supply increases, or as demand starts to back off, that speedometer starts to cool down. And what we can see here, the little gray line here, last month was a little bit higher. We're starting to tick down every month as inventory climbs, as things like we can see price reductions or relists happening. And so those are starting to kick in your local market with your Altos report. You take that report, and when you're working with a buyer or seller, you're working with, for example, in the listing presentation, you take the Altos report, you can say, Are you a big geek or a little geek? Because if you're a big geek, there's a lot of data here. But if you're just a little geek, I'm going to put this report in your inbox every Monday, and I want you to look at one number. We have your house listed. We're going to list your house now, and this market is changing. Everybody knows this market is changing. We're going to price it correctly so that we can get ahead of the changing market. But if while we have your house listed, I want you to look at this number, this market action index every Monday. If this is falling while we have your house listed, that's the market giving us a signal that your demand is backing off. And we may want to, that's the market telling us that we may need to adjust the price of the home to make sure it moves before the market changes too drastically. And so this gives your sellers the power to know what the market is telling us before you have to. Ideally, then the seller calls you and go, hey, Mike, I've been watching this market action index. Maybe we should do a price reduction to make sure we sell this house before the summer gets too late. And so you want to have this in their inbox every Monday. You want to have it. You want to set those expectations in the listing presentation. And you can say, I want you to look at one number. Here's what the market action index looks like over time. The dark red line here is the smooth trend line, which is what's in the speedometer there. The light red line are the weekly readings, and they bounces around a little bit more, but we can see that the light red line is each week is now at the far right end of this chart is dropping fairly rapidly from this ultra high levels, record high levels, now down to getting back to normal. Over 30 in this is still seller's market conditions. That means we have sufficiently tight inventory, we have sufficiently strong demand, homes are selling, prices are holding up. All of those things are happening. And so we're in seller's market territory. We're moving though from crazy seller's market territory to more normal. We actually haven't really been in buyer's territory for a long time. You can see at the beginning of the pandemic in March 2020, there was a little downtick when normally things are climbing. You can see there's like 4 weeks of downtick when things were normally climbing here, right in the middle of the chart. And then promptly we started watching that market action index climb. And that's when we knew it's, mid-April, and we said, people are buying homes everywhere. And we could see it in the market action index. You could see it very quickly. So as this gets closer to 30, that's the signal for your sellers. And especially if you have sellers now who are still trying to get a high price, they're trying to, for example, test the market and they don't care about how long it's going to take you to sell, then this is how you use the market action index to communicate to sellers about how to act right now. Like, I want you to look at one number. All right, let's switch back to local data. So, I've been talking about price reductions. The changes each week in price reductions have been really fascinating to watch. And so I have here ranked the 50 top markets with price reductions. These are all markets with at least 750 homes for sale. And right at the top of that list is Boise. Boise had a ton of inbound migration, especially from California, over the last 2 years. And you can see where normally price reductions might be 30, 35, 40% in Boise. All of a sudden, during the pandemic, 8%. So people are buying everything in sight. People are coming in from LA. Last summer, it cooled off. And what we're seeing right now is you can see the steep increase in price reductions. 40% of the homes on the market in the Boise region right now have had price reductions. That's up from 10, 12, 13% earlier this year. So that steep curve is what people feel right now. So listing agents, like, this is your opportunity to communicate with sellers how to do it right, how to price right to make sure it moves. Phoenix what a surprise. Phoenix is in general has higher price reductions than say, for example, California. Phoenix has generally greater inventory, more investors, that kind of thing. So normally 40% might be normal for Phoenix. What we can see is Phoenix was super fast. Only, 40% is normal with price reductions, but only 15% need to take a price cut. This spring it was under 20 and now it's up to 40. You can see that steep price. And if you're selling in Phoenix, you'll know it. If you're not priced right, you'll know that activity right here. We see New Orleans is higher on this list, but New Orleans was never as low, only 25%, 26%. So even as New Orleans slows, New Orleans is a slower market in general than, say, Boise or Phoenix. But you can see the Florida markets. Here's the Florida markets going from 17% to 35%. In California, the Sacramento, so this is the Central Valley, which is also kind of acts like Boise. It's people move out of LA or San Francisco to the Central Valley. And so, we had 15% and now up to 33% in Central Valley. Salt Lake City is one of the big moves of the last couple of years. Only 8% price reductions in Salt Lake City in February, when normally might be 35 or 40. And we're up to 32 now. So you can really see where the biggest markets that had the biggest influx with the highest demand, those are the ones that are adjusting most quickly. There are places in like the Northeast that are adjusting, or the East where they're less boomy markets. And so here's Baltimore has 28% price reductions, climbing, but still lower than normal. And so in general, you can imagine that the homes that have had the greatest, the markets that have had the greatest inbound migration and appreciation, you can really see what that those are the ones that are experiencing the slowest ones most quickly. Let's look at Boise at the local level. So this is for the Boise metro market. Here's the market action index. Remember this, I want you to look at one number. Last month was in the 60s. Now Boise is down into the 50s. We can see that it is very clearly slowing down here. We can see that here's our price reductions. Here's the inventory for Boise. If I look down here at the inventory chart over multiple years, here's what we see. The little pip on the chart is a year ago, 2 years ago, and then 3 years ago is over here. We can see that Boise is one of the very few markets that now has more inventory than it did at the start of the pandemic. That's the first start of the pandemic. So 2 years inventory is higher than 2 years ago. Definitely higher than last year. Not quite to normal, not quite back up here, but getting close to normal. And so, and we can see down here in Boise, anything under 600,000 are the ones that are going the fastest. 700,000 and up, it starts to slow down. You can see exactly what's happening when you need to communicate in those price ranges to your buyers and sellers. Washington, D.C., the Washington market area has been a strong migration story over the last few years. And while inventory is climbing, you can see inventory is just barely higher than it was last year at this time, and still lower than 2 years ago, and way lower than 3 years ago. So you can see a place like Washington has had longer term boom rather than the real strong last couple of years of, say, Boise and Salt Lake City. So that's an interesting view. Places like Washington, D.C., anything under $1 million in D.C. is still going under, in a couple of weeks, slowing down slightly at $1.5 million. So that's the whole D.C. metro region. Cape Coral, Florida, I pulled up because this is one where the price decreases are starting to make the most dramatic change. We had 16% with price reductions early in the year, and now we're at 34%. You can see it's just on a straight uphill, where normally we get a little bit of a curve. This spike back here, this is the pandemic lockdown. This is the first few weeks of the pandemic. It had a big spike, and it took a little bit before people started buying there. That's price reductions in Cape Coral, Florida. And a lot of the Florida markets are, feeling this. There's inbound migration, a lot of investor activity. That kind of thing is what we can see happening in Florida. Here's Phoenix. So Phoenix is one that is, you can see, going from super, super fast on the market action index, slowing down very dramatically, still very fast, but slowing down, like a big move month over month in the market action index. And sellers need to know this, right? And this is how you can show. If a seller thinks it's still here and they want to overprice, we need to show them that this is happening. And they should keep watching this every Monday. Like, we're going to put this in your inbox every Monday. So this is inventory for the Phoenix metro market. Phoenix is up year over year in inventory, not quite where we were 2 years ago, and way below the long term. So my expectation here is Phoenix gets up here much closer to where it was in its normal state. And then the question is, how far does it go beyond that? You're like, are there recession pressures or other kinds of things that cause investors to unload properties? There aren't really things like that led to the bubble burst. The no consumers have a bad mortgage. Everybody has a ton of equity. Everybody has really low rates. So that boom where people were forced to sell because they had this lousy mortgage, that doesn't exist anymore. And so that's why it's really hard to see, do we get to September? We keep climbing. We have a nice normal arc of inventory curve, seasonal curve, and then we then settle in normal. Like, that is really the question. Or do we blow through that because buyers are now with a high rates can't afford anything? We don't know. That stuff isn't in the data yet, but it's certainly stuff to watch, and you can watch it in your Altos report every week. I'm going to do real quick with Texas, because Texas is actually slowing less aggressively than, for example, Arizona. Texas has just now year-over-year inventory gains. This is state of Texas, and way lower than normal. And what's interesting, though, is Austin is the biggest boom market of Texas with the biggest inbound migration. And so look at inventory in Austin is adjusting very rapidly, has lots more than last year at this time, and is getting very close to the 2 years ago, not still way below normal. So you can see that Austin is behaving closer to, say, Salt Lake and Boise than it is to the rest of Texas. Okay, it's coming up to the top of the hour. That's all the time we have to share the data today, the local data. We've been talking about a lot and how to use Altos market reports with your customers. If you have buyers and sellers right now who need to understand what's going on, go to Altos Research, click the Get Started button, get the data today, and we can get it so that you can get it in the inbox for your customers right now. And we can get it to them today. Your buyers and sellers, they need to understand this market is changing so fast, and it's changing all over the country, but different rates. And so your local markets, you need to be able to communicate that for them. We will so go to altosresearch.com, click Get Started. You'll be able to look at your local markets. You'll be able to get the ebook, all of the good things when you go do that. As always, thanks for joining us. I really appreciate the attention. I love that we have so many people interested and joining these webinars each month. Stay tuned to the Altos YouTube channel, and we're going to stick around in the chat box for just a few minutes and see if there's any other questions that we can answer. There are links to Altos in the chat, so you can go grab those. All right, everybody. Thanks so much.